great to see you. Thanks so much for joining us. And I know you've had a buy rating on the stock, maintaining that but lowering your price target. Why was this such a big shock?
Good to be here, Wilfred. Thanks for having us again. So I would say a couple of things. One, I want to focus on two things that are beyond anyone's real control. One, you're seeing e-commerce volume trends normalize to pre-pandemic levels. That's something that we spoke about in our research back in October, November of last year. Management spoke about this about a quarter ago, and it's actually happening. And because of that, you're seeing some of the other pure play e-commerce names down 9–10% today. The other thing that's beyond, I would say, PayPal's control is consumer spending. The company did talk about weaker consumer spending last quarter. We actually started to see that reflected in the card metrics data that was reported by the 4 largest banks back in the September quarter. We've seen that in January as well. What's really saving things and masking that weakness is the fact that you have inflation that's kind of bumping up average ticket prices. So we do concur with what PayPal is saying, which is they are seeing weaker consumer spending, specifically given the fact that the prices of staple goods went up a lot. So you're spending probably less on discretionary products. Now, the dilemma that everybody's having is, well, why isn't that, why is MasterCard and Visa's numbers relatively okay, and why they've been relatively more upbeat? I would say that the networks are benefiting from this bump in average ticket price because of inflation. But on the other hand, PayPal's not, likely because of the change in the mix of transactions that they've had. So pre-pandemic, there was a pretty healthy mix between transactions that are linked to debit and credit cards. And these are lower yield transactions from PayPal versus ACH-based transactions. Mm-hmm. These are transactions that are linked to your bank account. During the pandemic, ACH mix went up. Now it's going back to the mean. And in our view, that accounts for the roughly 400 basis points reduction in revenue growth for calendar 22. So these are things that are that the company can control less. The two other things that are more relevant to PayPal are the fact that the separation from eBay is taking a bit longer than expected. What a lot of people are not realizing is that merchants don't like the fact that they are getting shifted. Their platform is getting shifted away from PayPal, where they have a very high conversion rate, into Adyen, which is a less known platform. So that's taking longer than expected. Probably by the end of June, everything pretty much after that goes away from the P&L. That's a good thing. And then lastly, the execution side in terms of monetizing the active accounts. The company did decide to prune accounts that are not being monetized and focus more on about a third of their active account base with incentives and targeted marketing. That's probably the right thing to do down the road. Net, not ideal. A lot of different moving parts here. Probably the second half will look better than this half. The good news is that the PE multiple now is back to where it was pre-pandemic, roughly mid-20s. And they'll probably exit this year with roughly 20% top line growth.